It is a great pleasure to be back here in Valuespain another year. Let's start with a brief introduction of Lyft. We are a team who comes from the private equity, and we have the experience of being acquirers of businesses, being owners of businesses, and we saw the opportunity to use that experience into the public investing world, combining the best elements of private equity with the best elements of value investing. So with this mindset, we invest in equities and bonds on a global basis, looking for superior risk-adjusted returns along the capital structure of companies in sectors we know well. On top of that, on our equity strategies, we follow value investing principles, but we like 4 investment theses, which are forgotten holding, contrarian companies, listed private equity, and activists. And today, we're going to talk about an industry that we like a lot, animal health, and in particularly pets. We've been investing in the animal health industry for a long time. We currently hold 4 portfolio companies across the industry value chain. I'm going to tell you why we like the industry. We like the industry because it's growing at 4-6% per annum on a structural trend, given some long-term benefits. And those ones are, this business is divided by livestock and pets. So on the livestock side, there is an increase in demand of meat and milk, given the increasing demand of the population. And also there is a productivity yield, which, given that for producing milk and meat, there is an increasing need of increasing the yield, there is also an increase of medicines on this sector. No? So that animal health on the livestock is growing around 6%. On the pet side, there are 2 drivers. The first one is the increased pet ownership in emerging economies, and on developed markets, the humanization of pets. So we take much more care of pets. The business is more resilient through economic crisis. So this is the reason we like this industry. And this industry has been consolidation for the last years. Now, top 4 more or less have 50% of the market share. Most of them are part or used to be part of a normal pharma company. But there are many independent companies and many pure players. And one of the pure players is Vetoquinol, which is one of our top 3 companies in our portfolio. It's, as I said, a pure player in the animal pharma industry. It's part of our contrarian strategy because we believe that the market doesn't fairly value this company. And we believe that this company is worth at least 82 euros per share, which is more than 46% upside on a 3-year time. So let's talk about the company. So Vetoquinol is a French company. It's a top 9 largest company in the animal health industry. And what we like is a very, very, very attractive business, which has grown at 7.8 CAGR, EBIT CAGR, during the last 14 years. It has over 26% ROCE, robust cash flow, and very important, particularly for nowadays under uncertain times, it's a very resilient during economic downturns. So the business is 44% products related to livestock, and as I said, it's more related, and the clients are more like the livestock producers. And as you can see, the products are antibiotics or reproduction products. And on the pets, it's 56% of the business, from our point, more attractive, and it's more similar to the humans. Let's say products are more in the sense of OTC products, over-the-counter products, like more related to treat pets as humans, okay? And some are related to the heart failure, otology, even a street treatment. So we love this company. For us, it's like one of the perfect companies. You know, you have great financial track record, very resilience. Like if you see here, I mean, what is the crisis? No, this company has been able to grow, as I said, 7.8% EBIT growth during the last 14 years, with a robust cash flow generation, and very important that this is not shown here, with a very clear accounting, very easy to understand. This is, and I'll say later, it's a family-owned business in France, on which you have incentives to pay not too much taxes. So all R&D of this company is expensed through a P&L. So this is something that also we like. So as I said, this is a family-owned business owned by the Freshim family, which has more than 66% of the company. It's undercover because only 2 local French analysts cover the company. And from them, I would say only Gilbert Dupont is, let's say, quite active with the company. And they have it in their conviction list with a target price of 77. So, but this is still very undercover. And even in the French investment community, when you talk to investors, you say, who, that company, which one? So they don't even know. Most of the people know some of the competitors, even like French Virbac, but they don't usually know Vetoquinol. And the company has very good ESG policies. So it has, for this size, or the size of the company, has very good ESG policies. The company has been awarded in several awards about ESG, and it's something that we like as well. So on terms of valuation, and here, this is a tricky part, and as we know, value investors, there's always this part of the tricky multiples. No? So if we take the company multiples for next year, we are talking about less than 9 times EBITDA, less than 11 times EBIT, less than 15 times PE. So scans and ROE, this is a little bit high multiple. We say this is, for us, is an undervalued company given these reasons. First, fundamentals. Company has been growing, stable, very well under economic downturns, cash flow generation. So we believe that this company, just by intrinsic value, worth to pay these multiples. Second is relative. So where are the peers? This is a very attractive industry. Where are the peers? So most of the peers are around the 20 times EBITDA, or 22 EBIT, or 28, or even 30s or 40s PE ratio. So this is 50% discount to the peers. And the third, and more important for us, as being in the past acquirers of businesses, is that if you put this company up for sale, it worth at least 50% more. Whether it's industrial, whether it's a private equity, we'll buy it for 50% more. So with this perfect company, what's the trick, no? So we're going to identify several factors and to reason why the valuation is low for us. So the first one is the antibiotics exposure. No? So there has been a more growing pressure in the US, but particularly in Europe, to reduce the use of antibiotics in livestock animals. So the company in 2011 had 43% of exposure to antibiotics in the portfolio, but they are moving during the last years to get a 25% in 2021, thanks to the development of new products. So it's not that antibiotics is going down and the portion of antibiotics in the whole picture has gone down because of the lost revenue. No, it's just antibiotics is not growing, it's slightly declining, but the rest of the portfolio is growing. And the good news is that the rest of the portfolio has higher margins. So another let's call it issues. Wow, this company accumulates cash. 111 million euros in net cash. 16% of the market cap. Inefficient capital structure. So yes, but it's not such a bad problem, okay? So why? Because the company would like to do acquisitions. And the company has done acquisitions in the past. But this is a family company, very conservative. And they don't want to overpay. So for the last years, they said, look, multiples in the industry, they are not good, wait and see. Wait and see. So they've done acquisitions, but very bolt-on acquisitions, okay? And in the past, acquisitions, like largest one was more than 15 years ago, 10 years ago, which represented like 40% of the total company at that time. In the recent times, the last one was like 10% of the total company, okay? So other thing is when I said, like, for many people, it's not cheap. This is the PE ratio. If you adjust with the cash, it's less than 15. And peers are almost double. Other reasons, low analyst coverage. So undercover, as I said before, perception of low liquidity. Because when you look at the trading volumes on a market basis, they are quite low. But we've been in the company for more than 3 or 4 years. And we've been contacted several times from some of the brokers. And there are amounts of 1.5 million sometimes transacting. So it's apparently low liquidity, but not so much. Okay, this is a free float of 200-something million. So if you believe in the business and you are here for the long term, with time you can build your position. And the third is the very conservative management guidance. They are very humble, as I said, very low profile. They don't want to oversell. So what happens is usually they overachieve year after year. So after the past impressive growth, what's next? So on the top line for them, first is continue their US expansion. So US, they've been growing at almost 7% for the last 4 years. So they keep investing there. Second is the strong R&D pipeline. The company for the last years have increased a lot the R&D expense. And it's important to mention, they increased the R&D expense without eroding EBIT margins. And now they have, for the next year, a pipeline of 50 new products, of which 20 will come in 2019 and 2020. And that's some of the new pipeline. We have seen that in the last quarter has increased the organic growth a lot. On the margin side, they have, let's say, 2 levers, 2 drivers. First one is what I said is as antibiotics and other, let's say, non-core products are decreasing in weight, but not so much in volume, so just in weight, margins are expanding because the new products have higher margins. Second point on margins is that they are under an industrial optimization plan. What does it mean that? They invested in CapEx to renew their main site in France, and also they did an acquisition 4 years ago in Canada. So they had 2 sites in Canada, and they have been moving progressively and concentrating from 2 sites to 1 site. So that will also improve the operations of the company. Also, they are trying to reduce, and this is the reason they make this breakdown. They're trying to reduce some of the SKUs because they want to reduce some products that are not such profitable or maybe not as good as others. So how we see the business in terms of projections. We always like to do different cases. And again, it's part maybe of our private equity experience in the past. So we also want to see the downside, particularly understand well the downside. So just here, and I will develop more later, so we have built different cases. On the downside case, we have pressed a lot the margins. And as I said before, this increase in the margins have been even under a higher than usual R&D expense and with the antibiotics pressure. So as the antibiotics pressure fades, company also will be able to sustain those margins. So when we want to see the upside of the business, we have brought what we used to do in private equity. So it's like from the share price today to our target share price, how it's built in building blocks. No? So we have 6 euros, which we consider with a low execution risk, which is growing at 4% EBIT growth to the next year. This is lower than the past. And here you have operational leverage. So we are taking into account that the revenues are growing less than the market. Okay? So then you have re-rating, because we believe this company worth much more. And then we have the deleverage, which is 8 euros per share. So if you want to be conservative, just take out the re-rating. But for us, there is a lot of upside in this business, because also we're being conservative in this base case. So if you want to take from the different ranges from our downside case to our upside case is more or less management target growth and a little bit more of re-rating. But if you want to take the price right now, so the price right now is just taking into account today's valuation just and a little bit of growth. So we believe that this very good profile of limited downside to good upside. What are other risks in this business, on this company? So we like to evaluate all the different potential risks and upsides. And I mean, one of them is the higher antibiotic restrictions. So if they lost 50% of the revenues there, you get that impact. The antibiotics issue is that the governments are trying to enforce that there is less, let's say, consumption, avoiding abuse. But you cannot live without antibiotics. So antibiotics are needed. It's just a matter of their use, okay? So the main, let's say, issue with antibiotics would be France and the US, which have already, let's say, passed, more or less. And what's coming next is maybe Southern Europe, which is coming a little bit later. Other one is FX. And FX is very, very short-term issue. And it's just more or less a P&L. And P&L valuation view from the market. Because this is a company that most of the revenues are outside, so more than 50% of the revenues are outside Eurozone. So that impacts. But it's just, I said, it's just a short-term view. Sometimes it has happened in the past that they grow organically at 4 or 5%, but with the FX impact, they get to 0, 1. So sometimes the market can have a perception that the company is not growing. Another risk, vet clinics concentration. There is a concentration of vet clinics in the US and in Europe. I would say that most of that is, the big part is already done, and that can maybe put some pressure on margins in the company. But the company has not seen that, okay? And other risk, dilutive acquisition, no? If they buy at a high multiple because they have excess cash, etc. We believe the company has been very conservative in the past, so we don't believe that there will be this problem. Upsides, they get their management target growth rate. There is an improvement of the capital structure and the use of that excess cash. Another one is Vetoquinol is acquired by someone, or just they do a creative acquisition. So, for example, they are looking for a larger one, but they are very patient. And I think when I have talked with them about multiples, they have been always saying very reasonable. So just to sum up, we have a pure player in a growing industry under consolidation who successfully develop new products. They have been very good at new products R&D and to develop the business internationally. With a strong ownership, a family, which, by the way, there is one family in the company, but the management is quite professional. We have a very high resilient business who has gone through very well through the financial crisis with a recurrent and growing cash flow. More than 26% ROCE, growth of 7.8 EBIT during the last 14 years. And with upside on the opportunity to increase the organic growth through the new R&D pipeline that is coming out in the next years, and also to increase the margins. And then for us, very important is attractive potential upside with a very limited downside, okay? And we also believe that there is a strong case for re-rating in this company as the company diversifies more products, geographies, and reach a little bit larger size. And with that, open for questions.
Hi, good morning, and thank you for your presentation. I was wondering about the pipeline, because I don't know many things about the healthcare industry and the pharma industry in animals. How difficult is for those medicines to get passed through the FDA or the local regulators, in time and money?
It is much more easier. It doesn't take too much time. And it is, I would say, it's sometimes more a chemical thing. So when they hit the chemical thing to solve a problem, it's get approved very easy. So in general, the success ratio and the good thing about this industry compared to the normal pharma industry is that R&D expense is much lower. The success or the probability of success is much higher. Where you have a little bit more regulatory issue, more investment, etc., is in the vaccine side. They don't do vaccines. So in their portfolio, what they don't have, and their weakness, let's call it like that, compared to larger players, is the vaccine. But they are able to create new products which are, let's say, sometimes niche. Let's say, I don't know, like heart disease for dogs is quite of a niche market. No? So they're able to develop these products that meet a consumer needs, and the success is quite high. And you see something that is not only Vetoquinol, it's the whole industry is one of the great advantages compared to the normal pharma industry. And one thing I didn't mention, by the way, is that you have better price position compared to the normal pharma, because you usually sell to a large customer base and directly.
Thank you. I have two questions. First, can you differentiate the margins that are available in pet industry and cattle? And the second one, what about liability? Are there liability cases that you know of with peers or within the company?
What was the second question? Sorry.
Liabilities cases against the company for impact of medication.
Okay. Start with the second one. On the cases and litigations, there is residuals. So there is nothing relevant to say. There is not a material case against the company that can have a large impact. On the margins, they don't disclose openly, but you can count that the pets probably is like 200 basis points more than the livestock. But that can also be a little bit more Vetoquinol case because of the products. Because in some other players, it's not such the case. It depends a lot product by product. And for example, vaccines that they don't have, it's higher margin. And that's the reason some of the competitors have higher margins as well.
You said that livestock is very similar to humans, and basically pets is like diseases are more similar to human diseases. So how difficult is for pure pharma companies to replicate them in terms of R&D, because they can overspend them, right?
To replicate their products, you mean?
Yeah, on the pet side.
On the pet side.
Because at the end of the day, they have larger scale. So if it's not that dissimilar in terms of like the disease, like I get that. I presume that the treatments are not that dissimilar either. So.
Yeah. Why, for example, like one of the large, like Zoetis doesn't compete directly with them in some of the over-the-counter pets products? It's terms of size. So the R&D of the large pharma are focused on, let's say, more blockbusters, And for them, they are focused more on the, like, oh, this product, it's a niche, I can sell it, I don't know, maybe it's a 10, 20 million euro revenue. It's interesting. 10, 20 million euro revenue for Soeris is nothing. So it's basically that. So for them, it's like a portfolio of complementary products that no one delivers something in that segment.
Okay, so is it fair to say?
I'm sorry, another thing is, one of their strengths is that they have, and always people saying that in the industry, when you talk to people in the industry, is that their distribution network. It's a sales force. So it's really sales force is saying they have to talk with the clinics, and they talk. So they have control of their sales force directly to the clinics. Whether they have a distributor in the country, because for logistics it works, they have it, but who push the product, who goes there and visits, look, this is a product that has these attributes, so it's good that you put these cookies for your dog because it will be less stressful. That's their sales force.